Oil spikes, headlines scream war, stocks drop. This is where the long-term investor makes their biggest mistake. They confuse volatility with permanent damage. Turbulence does not mean the plane is crashing. And in the markets, geographical panic does not automatically mean your thesis is broken. This is Captain Pierce with Skies Capital. Think clearly, invest better. Today is day 14 of a 30-day series, and we are talking about war, oil, and market panic, and how long-term investors should think clearly when headlines turn volatile.
Let's start with the sequence. On February 28th, the conflict begins. On March 1st and 2nd, the Straits of Hormuz close and immediately puts a major portion of the global oil supply at risk. Oil surges, gas prices move higher, inflation fears come back fast. Then, on April 8th, a fragmented ceasefire is announced. So yes, the market had a reason to react. But reacting to a shock and correctly interpreting the shock are two very different things. War affects the markets through four main channels. First, energy. Oil supply is disrupted. Costs rise across transportation, manufacturing, shipping, and the broader economy. Second, inflation. Higher energy prices push input costs almost everywhere, and that can change expectations for interest rates. Third, sector rotation. Some sectors benefit from higher oil. Others get repriced lower as inflation and rates move against them. Fourth, global divergence. Energy exporters can outperform while the energy importers absorb the pain. So this is not just a headline story. This is the market repricing cash flow, inflation, and risk. Now here's the part that matters most. Before you react, ask four questions. First, does this change the business model of what I own? Most of the time, the answer is no. Railroads still move freight. Pharma companies still develop drugs. A great business usually keeps doing what it does best. Second, does this change free cash flow durability of my holdings? That is the real question, not the headline, the cash flow. Third, is this turbulence or is this genuine thesis change? Most wars create volatility. Far fewer create permanent impairment. Fourth, am I reacting to price or to evidence? A stock dropping 10% is a price event. It only becomes a thesis event if the underlying business actually weakens. Now, calm does not mean complacent. There are real warning signs that would change the thesis. If energy costs stay structurally high for months, not weeks, margins across parts of the economy could reset lower. If the Fed shifts from cuts to hikes because inflation reaccelerates, valuation pressure could spread quickly through rate-sensitive sectors. If a company's supply chain runs through exposed regions, that risk needs to be checked directly. And if stagflation becomes the base case, slow growth and stubborn inflation at the same time, that is a much more difficult environment for long-term duration assets. That is when this stops being noise and starts becoming portfolio relevant. But there are also reasons long-term investors to stay calm. History has shown geopolitical shocks often create opportunity, not just damage. Strong businesses with pricing power, durable cash flow, and limited direct exposure usually absorb the shocks better than people expect. If a ceasefire condition improves, oil normalizes, some of the inflation pressures can fade faster than the headline suggests. And most importantly, volatility often throws high-quality companies into the same sell-off as the weak ones. That is where investors could win by staying analytical while everyone else gets emotional. Here's the bottom line. Turbulence is not a change in the flight plan. A geopolitical shock like this deserves attention. It may require portfolio adjustments if it becomes prolonged and structural, but it doesn't justify panic. The job of the investor is not to react to the headlines. The job is to test the thesis, check the cash flow, stay rational while everyone else gets emotional. This has been Captain Pierce with Skies Capital. Think clearly, invest better. This is for educational purposes only, not investment advice. If this helps you think more clearly, hit the like button and subscribe for day 15.